Okay, back to share screen and do homework. All right. I don't think either of you and anyone watching would have to go over these formation issues, right?
No.
Carmen, are you all right with those? Yeah, I think that's something you can get from the book, and many of you already seem to have a strong grasp of that.
Yeah, I pretty much went through those, no problem.
Okay.
It's just getting accustomed to the formulas, but once I got started on it, it's okay. It's just
Okay. By determining if the return is more than the expected level, or more than expected given the level of risk. This is, as I said in class, I think, this is the, what did I call it? The brass ring, the gold, golden center. It's all those things in finance. The idea is to get risk with, it's not just about the reward. In other words, someone could tell me they made 15%, and they could be bragging about it. And after I found out what they did to get it, I could tell them it was stupid, and they'd be furious with me because they'd be bragging about how much they made. And I said, "Do you realize how much risk you took to get that?" They still would claim that it doesn't matter now because it's all in the bag, but people who take a lot of risk sooner or later wind up taking a huge loss.
Isn't that called Vegas?
That example is worthwhile. Don't tell me what a great return you made until you can show me how much risk you took to get it, okay? What was your question, Francisco?
No, I just said, isn't that called Vegas?
No, not really.
Well, I mean, in a way, because I mean, you are taking risk, and that's what Vegas and all these places are about.
The problem with Vegas is not that you're taking risk; it's that you have a bad risk reward every time you play, and different games have a different,
Oh, sure.
So my point is, if you have a bad risk return, you shouldn't play it any more than you have to. So a lot of people think that you're better off taking the full amount that you're willing to lose and put it on red when you walk in the door on the roulette table, because you're only taking about 0.5% risk, versus if you make 100 bets and each time you have 0.5% risk, you're making it increasingly harder for yourself to come out a winner. So they're two different things. One is, I mean, yeah, Vegas, we associate Vegas with taking high risks, but I submit to you that you can lose a lot of money faster in the commodities markets or the currency markets. Okay.
Sure.
So the return, the risk reward is key. And really, in this class, when we see more risk, we assign a different or higher discount rate, which has the effect of lowering the price. But it's done, the price is lowered using the discounting mechanism, so that rather than just arbitrarily pick a price, we pick a price that gives us a specific return that we're targeting. And so there's a slight difference. Rather than just say, well, I'll pay this, we actually know why we're picking that number, because it gives us the return that we require. So it's an important distinction between saying it's the same as lowering the price. It really isn't, unless someone has a calculator in their head. Okay, and this one about profitable projects, we talked about it. It's common sense. There are a lot of smart people out there who are paid to look for return and value, and what they call in economics rent. The term rent in economics means surplus that's out there that can be bought or exploited. Okay. Number 7, these are all agency things. stock options, long-term stock market price. Okay. Well, I guess we did go through most of these. Corporate governance and agency theory. Okay. And maybe I did these myself. I don't know if we did these.
We all did this together, and then we started number 2, I believe.
Oh, okay. Thanks. Now I understand what you were trying to tell me. Okay. So then, all right. So I just need to go to a different module then. So I'll save that and move to.
What I was having problems with, and I don't remember the exact problem that it was, but it was the homework. I had pretty much no problem with the homework. The quizzes, for some reason, I had a little problem with the quizzes on chapter 1 quiz. I believe I had 4 wrong, I think.
Okay.
4
Do we have somebody else who's joined us just recently?
I did. Robert Williams.
Who is that?
Robert
Oh, hi.
Williams.
Yes. How are you feeling?
Oh, sore.
Sorry about Wednesday. I should have tried to send you a link rather than just the meeting ID because you didn't.
Well,
but
I guess I'm not sure. What time does that start?
it was 6 o'clock.
Yeah, I tried to get in, but it wouldn't. It said there was no session.
Oh no. You know what? Okay. Well, in the future, if you have problems like that, just send me a text.
Well,
so I
I'm
know
going
where you are.
to tell you right now that I most likely won't. My knee's still very tense, so I'm probably not going to make it to this week's session either. If I could do it,
Okay.
if I could do it from here, that would be great.
Well,
Do
the
a
thing
link like
is,
this.
yeah, I mean, we don't encourage students to watch the meetings remotely.
Right.
But if you have a medical excuse, then a note would be super helpful. Then I'd have no problem. I'm just saying, I wouldn't personally have a problem, but as far as the policy goes, with a note, I could definitely accommodate you.
Yeah, I'll go get one on Monday.
Awesome. Thank you, Robert, and welcome.
All right.
Francisco, did you say chapter 2 we have? Module 1, chapter 2? Is that what you're saying?
Yeah, I believe we got up to 2.7, I think.
Okay.
2.7 or 2.8, thereabouts.
All right. Yeah, good call. You've got a good memory. Okay, so I'll look at 7 again. By the way, I looked at the text and I learned a little bit about this whole mystery surrounding the calculation of nominal and real interest rates.
Mm-hmm.
And I might be able to share that with you on the screen here in a minute. But it was just a new insight as to why we have to multiply that little extra amount. And this might have been the one. We'll see.
No, I believe that was on
Was it?
chapter 1. It wasn't chapter 2.
All right. Well, anyway, remember, and Robert, I don't know if you've been able to access the book at all. Have you been able to look at the first couple chapters?
Yeah.
Okay, good. Then what we found, and it's foundational stuff. I mean, as you go through an education, and if you get into a career in management or finance, understanding interest rates is extremely beneficial because they drive so much in our economy. And it's not necessarily a good thing, but our economy has become increasingly financialized, where everything is about access to cheap money and borrowing and credit, and so understanding what forces impact interest rates and inflation and so forth valuable stuff, deep ideas in the field. So the idea is that we have at the very bottom of a kind of pyramid, if you will, a base interest rate that has no risk for no credit risk. In other words, you don't have any risk of not getting your money back. A guaranteed principal, if you will. And you also don't have any risk with respect to time and the chance that interest rates could go up or down and change the value of your principal. So the riskless rate is usually a short-term, very short-term government treasury bill rate, for example. They talk about notes in this example, and while you can have what amounts to a treasury, it would be a treasury note. Anything over a year is usually a note, up to 10 years. Then it becomes a bond. And under a year is a treasury bill. So we're usually talking about treasury bills or T-bills when we talk about risk-free securities, because there's no credit risk and there's no maturity risk. They're plenty liquid. In other words, you can buy and sell them all day long, as many as you want practically. And I mean many as in tens of millions of bonds at 1,000 apiece. And so there are no effective risks at that point. But once you start going out in time, you add maturity risk. If you're talking about a lending agency that is not the government, then you have credit risk. And if the bond is not very liquid, you could have liquidity risk. And for each of these risks, the investors require a premium. And so, and if you're talking about global bonds, what would you introduce into that picture? Who wants to take a guess at that? How about currency risk, right?
Well,
anyway, let's look at the question.
Well, the currencies change day by day. I mean, even
so do interest rates. But the point is, now you've got one more thing. Exactly. I mean, currencies are extremely volatile, and interest rates are volatile too. For example, in London, when the Brexit vote hit, the British pound dropped. I don't know if it was 10 or 15% that day, but it was some enormous jump.
Well, and it continued to drop. Isn't it at the lowest it's ever been? I mean, I've been to England before, and
it could be. It could be.
It's
okay. The present real risk-free rate. Now here, remember, I'm gonna, I've got to set this up a little bit. Oh, I didn't do it right. I wanted to go to the whiteboard. I'll go to the whiteboard for just a second. And so you have, don't forget that the general formula is that you have the nominal rate, which is the going rate. Something went weird here. Okay. All right, so you have the nominal rate. And then you have the inflation rate. And then you have the real rate. And so the nominal rate of interest, the market rate, minus the inflation rate equals the the real rate, excuse me. Okay, so the reason I bring that up is they are giving us, in this example, they're giving us the risk-free rate first, which is not the order that you usually get it in. So they're saying the risk-free rate is 1.7. Okay, so that would be the real risk-free rate. And so now we're not starting with the nominal rate. That's what I'm trying to say. Does everybody see what I mean by that?
Yeah.
Okay, then inflation is 1.7 for the next 2 years. And so what we have to do is back into the nominal rate, the market rate. So in the first year, we can calculate the nominal rate. What do they ask us? They want to know what the maturity risk premium is. Well, we have to, for this 2-year treasury note. All right. So this 2-year note, I'm going to create this over here as soon as this thing lets me. All right. And this is 5.4, but let's remember this has 2 years in it. And this is the nominal rate, right? And then we know that there was, in the first year, how do we get the nominal rate? Well, we just add the risk-free rate, the real risk-free rate, or the real rate, to the inflation rate, right? Because they give us the inflation rate like that, and the real risk-free rate, the real rate, and we know that the real rate plus the inflation rate is the nominal rate. So the nominal rate has to be 3.4. For the short term, whatever it is, maybe it's the 1 year, let's call it the 1 year rate, perhaps that's what they want. And so we're trying to figure out how much extra we're getting for this, how much maturity risk premium we're getting for this 2-year note. So we have 3.4 was the 1 year rate. Let's see. And so, yeah, whatever the inflation rate continues to be built into this 5.4, we have the inflation rate, the risk-free rate, and then we have to have, something's got to make up this difference. And so we decided that it was, it had to be 2% because this 5.4 includes an inflation component, and it includes the risk-free rate, the real rate, inflation rate, and the risk-free rate, or the real rate. I shouldn't say the risk-free rate, the real risk-free rate. So all we did was just take what we knew about the real rate of return, the inflation rate, and the difference had to be the difference had to be the maturity risk premium. Okay. Now my question is, how did I check this answer last time? I don't remember. I think what I have to do is set the permissions or something to let me look at it. But this should be right.
Well, if you press question help and then it'll show you the formula.
Really? Okay.
Yeah. Because that's what I did when I was working and when I showed you the formula.
So maturity risk equals treasury note yield minus nominal risk-free rate.
And if you press continue, it'll show you a little more.
Nominal risk-free rate equals approximately. Okay. Well, we did that, and so
Press continue. And then,
No, I mean, I can see what they, I can see where they're going. I'm pressing it, but I don't think it's going to give me any more.
no, that right there, that continue.
Oh, okay.
See, and then it shows you the actual work.
But Bill, you should be able to see down on the bottom right-hand side, check answer when you're
Well,
finished.
I don't though. I see
Huh.
similar question. Do you see that? Do you see where it says similar question down there?
No.
Oh, all right. Well, anyway, this appears to be what they're looking for,
Mhm.
which is often anybody's guess. Okay.
The question that I had a question on last Wednesday was 2.6, but we went through that already. That was the one where we had to take the sum of the two and then add them.
Okay.
2.
All right. So
Yeah.
let's look at this. Let's look at this one. I wish I could check these answers though. Maybe this time it does say check answer. I think what happened is I had already done the problem, so it wasn't going to let me check it again.
Yeah.
All right, so we're looking at some corporate bonds issued by Ford and trying to decide what the nominal rate should be. The real risk-free rate is 3. That means that we've already taken out inflation.
Yes.
And this rate is expected to continue on into the future without any change. That real risk-free rate. And inflation is expected to be constant at 3%. Okay. The default risk premium is constant. All right, so we're getting a bunch of stuff here. I'm starting to see a formula where they give you 3 and 3, right? The 3 was the base rate of the real risk-free rate. Is everybody with me?
Yep.
Inflation was 3. Default was 1.5, right?
Yes.
And there's supposed to be a period in there. Okay.
And the maturity risk is 0.02.
And the liquidity risk is 0.02. The maturity risk is what we're trying to, we have to get to that. 0.02 is liquidity risk. Very small, but there nonetheless. Okay. So I don't know if I need to label these, but what's another word for default risk? Anybody?
Maturity risk.
Yeah, how about credit risk? Probably a little more common. But yeah, it's the risk that you won't get some of or all of your money back. So, all right, so now we're close. Maturity risk premiums are shown in the pop-up window. So really, if we come up with this maturity risk premium, we'll be home, right?
Yep.
So far, we've got 7.5 plus that 0.02. So we're at 752 by my math. And certainly, don't take my word for it. A lot of times I try to use my human calculator, and it doesn't work. So I'll click the pop-up window, and let's see what the nominal rate is on these Ford bonds. Oh, they want to know, they want us to calculate 3 different rates from 0 to 1, 1 to 2, 2 to 3, and 3 to 4 years. So all we'll do is add those numbers to this number here,
Right.
and 7.52. And so I'll open this thing up and we'll look at it. Okay, so all we're going to do is add those 4 numbers. And what is it? 735, 70, and 1? Okay. So the answers in 0 to 1 should be,
757.
yeah, right? Don't you think?
759.
Oh, 759. I'm sorry.
Yep.
Right. 7.59. Thank you. All right. So now, check answer. Nice work. I'm gonna defer that to you all. Okay, Robert, are you following us?
Oh, yeah.
Okay. 1 to 2 was what, 30? Wasn't that 30%?
0.35.
So it's 0.87, 0.87?
Yep.
Okay. All right. And then this one was 70, right?
Yep.
So it's 8.22.
Yes.
Well, oh, good job. All right. And then lastly, it was $1, right?
Yes.
1%. Yep.
Or $1, listen to me. Yeah.
I knew.
And by the way, the last one, if I didn't want to say it in percent, if I wanted to say it in a fancier kind of an industry jargon, using a word called basis points, how many basis points would that last one have been?
100.
That's Carmen's guess. Francisco and Robert?
I have no idea.
Yeah, Carmen's right. 100 basis points is 1%. People in the industry can also call them BIPs for basis points. Okay. That's real language. I mean, I used to talk to the bond desk all the time. All right, so I don't know what happened, but it looks like they want me to do it again? No. Well, anyway, we're going to move on.
Okay. I moved on from there, and I was doing the last problem of the chapter 2, and it says that click on 210 to access this question.
Okay. So what's happening with this? This activity requires student to submit a project they completed?
Right. So it's actually pretty simple. You click on that, and it opens up an Excel spreadsheet, and then it gives you directions of putting in some subtraction signs in the Excel spreadsheet, and then you submit that, and then it grades it.
Yeah, I was knocked off for a second, but
So do I have to download both of these, Carmen? Do you know?
Yes, you do, because you have to one is the Excel spreadsheet, and the second one is the instructions on what to do in that Excel spreadsheet.
Okay. All right. All right, I hope this worked. I don't know what they want me to move. Yeah, my computer is moaning and groaning right now, I think, with all this extra stuff. I don't know what this application they want me to move is. What is that?
I can't read what you're reading.
Oh, okay. All right, so now I have to go to my downloads and open up those files, right?
Right.
Okay. We'll get there. This is good. If it weren't for you, I would have been a little, oh no, there's a zip file?
Mine didn't have a zip file.
Oh boy.
did
It was
you?
actually like 6 lines of words.
Yeah, I mean, I can deal with a zip, but, oh, there, okay, it opened it up automatically. One of them was a Word file, and one of them is an Excel file. Okay. I can live with that.
Were you able to get in there, Carmen, and do that last problem?
I was.
And then, let's see, here we go. Now I'll open the other one. All right. Yeah, thanks for your help, Carmen. This looks good. Okay, so And so you've done these then?
I did. So I finished all the chapter 2 homework, but I wanted to start reading on chapter 3. My concern is that the test in chapter 1 was a little bit different than what we did for homework. So I was worried if I go into chapter 2 test that it would also be different.
Chapter 3 is going to be a lot of accounting, and some of those exercises get pretty gnarly. So it's going to be it's kind of an island of sorts, not necessarily, but I mean it's very accounting concentrated in this class, and so we have to calculate things, and it's not my favorite part of the course, but I'll get that opened up for you because I don't blame you for wanting to work ahead. I think it's great. Okay, so they want us to calculate the solution, the real risk-free rate in 13B. Okay, I see that. And there's a Word file. It says, and they want subtract the inflation premium. Okay, blah blah blah. All right. Well, that's a pretty basic deal, isn't it?
I do believe so.
Yeah. Don't we just start out with the bond rate and subtract each of those things in turn?
So down at the bottom, you're going to put in an equal sign.
Yeah.
And then you're going to go back and say minus, and then you're going to click on those other two.
Okay, so equals B7 minus, right?
Yeah.
B7 minus B8 minus B9 minus B10. All right.
And it really didn't say it to do anything with B10, I don't think. I can't see what your screen says again.
I got 2.5% when I did that. Is that right?
Don't know. I don't have the homework open.
Oh, okay. That's the numbers. I mean, that comes out. Did everybody see what happened? I just created a formula up here. When I click on this cell, do you see the formula I wrote in that formula?
I can't see anything. I just see a blank screen.
Oh, you don't see? You can't?
No, there's nothing on there. We just see.
You can't see what I have open right now?
Nope.
Huh, that's odd because I'm sharing my screen.
Okay, well,
Now
I'll stop sharing and then I'll open it up again. And then I've got this homework thing open. So now if I share again, I'm sorry, I didn't realize that I had you all in the dark. You got the mushroom treatment from me, that's for sure. Okay, so now I'm going to go to this. I know what it is. I have to share my desktop so you see everything on my screen. And I usually do that, but that last time I shared a specific, what do you call it, tab. Does everybody see this now?
Yep.
Yeah.
Okay. What happened is this blue cell down at the bottom was blank and empty.
Mm-hmm.
And so I typed in this formula up here. Can you see the formula I just highlighted? Equal sign equals minus equals B7 or the 4.9, which, what do we call that 4.9? What rate do we name that?
The real risk rate?
No. That's the going rate for a 10-year Treasury bond. What do we call that rate? What in our
The risk premium. Is that the risk premium?
No, that's the nominal rate, Francisco. That's the going rate. That's the market rate. Okay, does everybody see that? The market rate, the nominal rate is the market rate. It's what you will pay. It's what you will get. Then we're breaking it down. They won't, I mean, when you go to borrow money, they won't tell you what your maturity risk premium and your credit risk premium and your inflation premiums are.
Mm-hmm.
The only rate you'll ever deal with as a consumer or a lender, for the most part, is the 10-year, is the nominal rate. So what we're doing is we're breaking it down based on the idea that we might have or might have calculated these other premiums or contributing, what do I want to call them? Contributing components to it. So the inflation rate was 2.1%. The maturity risk premium was 0.3, and there was no liquidity risk premium. Why not?
It just wasn't stated.
Because
Since there's
Ten-year
no
Treasury notes
liquidity
are
rate.
10-year Treasury notes are extremely liquid, the most liquid market in the world for bonds.
Is that typically the only type of device, or I mean, system that does not have, that is at zero typically?
No, that's a good question. Some bonds are considered extremely liquid. Treasury notes are the most liquid. Some corporate bonds are considered very liquid. There are other kinds of fixed income vehicles that are considered very liquid. There's corporate paper, and of course, some kinds of corporate paper. What else would be very liquid? I don't know. Some of the big, I'm trying to think some of the big telecom lenders have a lot of paper out there. Some of the big financial companies, the auto companies had a lot of in-house lending during the housing bubble, and there were other bubbles too. And Ford, GMAC, and Ford Motor Credit were big lenders, and they had a lot of bonds out. Okay, so this is the answer. When I hit that, I got 2.5% as the real risk-free rate because I took out all those other components. Everybody with me?
Yes.
Okay, and now I'll try to go back to the next question. And I think that was it, right?
Yeah, but you skipped number 9. Number 9 was exactly like 8.
I had no problem with 9. It was just I couldn't get
Oh,
into.
here it is. Okay. I just couldn't see how I was supposed to get to the next question. Okay. Is this the one you're talking about, Carmen?
Yeah, I think so.
The one that didn't we just do this?
So there's 2 of them that are exactly the same, just with different numbers.
Oh, okay.
It's
Yeah,
the same
all we're
thing.
doing here is we're going back up to the nominal rate. We're building it from the bottom up. And we're getting all the information we need from credit risk or default risk, same thing. Interest, the real rate, the inflation rate, and the default risk and the liquidity risk. And the only component we need to get to the nominal rate, the only missing piece is the maturity risk premium. And so we look up the table here. Were you able to see it the last time I put it up here?
Yes.
Yeah. And so here's another one. And because the numbers are different, remember we started with 7.52, right?
Right.
So for the first one, we'll add the 0.08 to that. And for the next one, we add 0.25, and so on and so forth.
Mm-hmm.
Does that answer your question?
No problem for me.
Well, I'm asking Carmen because
Oh, no, I'm good. I had it done.
I didn't know why you wanted
Oh,
to.
no, you just said you thought you only did 9 questions, and that's why you only did 9. That was
I
a template.
see. Got it. Thank you. All right, so now it says 10 of 10, but we've already done it, right?
Yep.
All right, so now, don't we have a last one? Yeah. I see what you were talking about. Question 9, meaning what? I see what you mean. You didn't mean 9 of that. You meant number of whatever. Well, wait now. Oh, this is the one I did.
Yeah, this is the same one.
So where am I missing here?
You just didn't do the work. That's all it's
Didn't
showing.
fill it in again. Okay.
Right.
You just didn't put it in numbers.
But what about this 2 to 10? We're done. Okay. So now I can move on to some other thing, right?
Yes, sure. The quizzes.
Okay. All right. And it's true. It's true that Pearson is notorious for suddenly throwing you a curveball on the tests and quizzes. So let's see what I mean. They'll probably manage to fool me on one or two of them. Just because they, I don't know. I think some of these people have a sadistic kind of thing. Well, we can't make it too easy on the little DS, can we?
Sure.
So in terms of the cost to organize each, which of the following sequences is correct? So yeah, you could probably do these on your own, but if we want to look at them, which one is the most expensive to create? I think the corporation. Would you all agree?
Yeah.
Yes.
So it's got to be number one then. I mean, it can only be number one unless a general partnership would somehow be, and then the corporation would be the cheapest. I don't think so. I'll just, we'll see how. Oh, I actually didn't click on it. So we'll say it's the corporation then. All right. Partnership disadvantages. Lack of permanent and unlimited liability, right? So B and D, right? Okay. Oh, yeah, B and D. In search for profits. Well, I mean, protectionism doesn't help the trade process, right?
Right.
All right, so. Working capital management.
B.
It's, what about Robert and Carmen? Would you agree that with Francisco?
What was the question?
It says working capital management is concerned with A, B, C, or D.
I said B.
I can't read it because it's real little, so
Yeah.
I'm trying to pull
I can make it bigger. Hold on. How's that?
I'm looking at it on my phone.
Well, I just increased the size quite a bit. I can make it maybe one more. There you go. Oh, I see. Did that help?
A little bit. I still can't make it out, but
Okay, so I think working capital management, it has to do more with day-to-day operations. So I'm pretty sure
yeah, how a firm can best manage its cash flows.
Right.
Yep.
Yep. Now I just have to find this little, where is it? The little thing at the bottom here. Yeah.
You just have to shrink it.
Now you have to go back down to be able to see the thing. Okay. So hello. Hi. Yes, who's calling? Oh, wonderful. You know what? I'm in the middle of a meeting. I thought you might have been one of my students. I'm conducting some classwork right now. Can I call you back in about half an hour, 40 minutes, please? Thank you, Lisa. Bye-bye. Okay. I thought it was a call, and I thought it might have been one of my students, or one of our classmates, so that they're trying to get in the room. So, but it wasn't. Okay. Principle 3. I think that's pretty basic, isn't it?
Level of risk.
Carmen, Robert, would you agree?
I
That,
agree.
yeah. Okay. And I realized, Carmen, if you can't read them, I'll try not to ask
That's
you
okay.
to chip in. But XYZ is traded on the New York Stock Exchange. The closing price was 20 a share. After the close, XYZ makes a surprise announcement that it has a new major customer. XYZ stock will likely open the next day. What? Higher?
Higher.
Stay at 20, open below 20, or open at 20, then go up. As
Open up
people read the news.
above 20.
Okay, Robert, what would you say?
Well, I would have said C, but I mean,
Um,
I would have said that it would opened at 20 and then started to rise.
okay.
But
The idea is that the information flow is so efficient that everyone will know before the market opens. And so they'll be bidding up the stock before it even opens for trading.
Well, just because the market is closed here, there's markets open other places worldwide.
right.
Well, I mean, I spent plenty of time trading in the aftermarket, after hours market, so I know what you're saying. Okay, well, which of the following statements about the corporate form of business organization is true? Well, number 2 is not true. I don't think. Number 1 says sole proprietorships are the most common, but they say it's limited to the amount invested in the business, and I don't think that's true. I think, you could be liable for your personal assets too.
Correct.
Yes.
Right.
So I would say it looks like D is true, right?
Yes. That's what I would choose.
Everybody agree?
Yes.
We may not get them all right. Who knows? The 5 basic principles include all of the following. Well, I've had some nasty surprises with this. I mean, I go through them, and sometimes if you're too cavalier, you'll miss a little thing. But and sometimes, when you have to draw the shapes and stuff, if you don't draw them just right, you get nicked too. So I've had some shocks when I finally submitted the quiz. 5 basic principles include everything except incremental profits determine value. Cash flow matters. Risk requires a reward. Money has a time value.
All right.
Pretty sure those are all there.
Process of elimination.
Yeah. Determine the best way to raise money to fund a firm's. Determining the best way. This is the term that's a little confusing. I touched on it in class. Anybody remember? I'll try to make it bigger for Carmen here.
Yeah, I'm trying to look in my phone for my settings. I have it so I can't turn my picture. I really think if I can turn my phone, would make it bigger too, but I can't find that setting.
Well, it says determining the best way to raise money for long-term investments at a firm is called the portfolio decision, the money flow processing, the capital budgeting, the capital structure. What did I say it was? It's a little confusing.
Structure?
It's budgeting because, well, actually, hold on. Determining the best way to raise money is the structure, yes. I thought this was a question about capital budgeting with regard to choosing projects. And that's why I said it's confusing, because budgeting sounds like day-to-day things. But yes, capital structure. And what are the 2 most common structures? Or what are the 2 most common vehicles to raise money for a company?
Sell stocks and bonds.
Stocks or bonds, and then in some companies in existence already have retained earnings. They have some cash.
Oh.
And of course, other companies also sometimes have the option to sell existing assets too. Okay. Oh, I can click on this. Capital structure decision. Too late. I'll go back. Get it. Capital structure decision. Okay. Shareholder wealth maximization means.
Increasing stockholder value.
Yeah, it's the stock price. Most of the questions will be that. And the idea is the stock price already supposedly includes longer term valuation concepts. What did I say was another way of describing the price of a stock? Do you remember? The price of a stock is the present value of all future estimated cash flows discounted back at some appropriate rate. We'll learn later it's probably the weighted average cost of capital or the internal rate of return, or depending on what you want to call it. The stock price is all the expected future values, future cash flows discounted back at some appropriate price. And so in other words, it's the present value of the stock, of the franchise. Does that make sense?
Yes.
Yeah.
Okay. That's a profound idea. I mean, people look at the price of the stock and they don't realize what that really represents, but that's exactly what it represents. Okay, so all of these provide limited liability except they say a general partnership. General partners aren't they don't have limited liability, I don't think. An S corp, the taxes flow through, but I think you still have some limited liability.
Yes, because I don't want you to drink up all my soda while you're here, so I want you to get yourself something.
All right, so would everyone agree that a general partnership probably is the answer here, the one that does not provide limited liability?
I
Right.
agree.
Yes.
No, just
I'm not positive, but
for the reading
that's
and
the one
stuff.
that makes the most sense. Capital budgeting
And then I
here.
forgot to put on there for you to pick up something for dinner.
Capital budgeting is
They're
concerned.
up in the front by the meat part. Remember where they used to be? Are you
Okay, so capital budgeting. Who wants to take a shot at this? Is it what long-term investments a firm should undertake? Managing a firm's cash, budgeting, planning sales of equity, or financing with debt or equity?
work it out? All right. Bye.
Well, capital budgeting isn't that capital budgeting for short term, more or less?
No, that's the confusing part about it. It sounds like budgeting.
I would say what long-term investments the firm should undertake.
Exactly. The firm capital budgeting in this case means how should we apply not only the capital that we have, but the access to capital that we have to take on new projects or try to improve the operation of existing projects to improve cash flows. And that can mean new plant and equipment, new projects, okay, acquisitions possibly. All right. And I'm not even sure I answered all of these. Okay, we've seen this one before. This is about the extremely profitable projects. And we decided that all of the above, remember?
Yeah.
Yes.
Okay, so 14 is advantages of the corporation include, this was A and C. We saw this one before. And so now we're probably going to get a complex one. No? Company A reports sales of 100,000 and net income of 15,000. Company B reports sales of 100,000 and net income of 10,000. Therefore, Company A's cash flow is 5,000 more than Company B's cash flow.
No.
No, because those are accounting values, right? Company B is creating less value for its shareholders than Company A.
No.
Company A's cash flow may be higher or lower than B's. That's probably the answer, right?
That's
Yeah.
that's what I put down. I don't
Okay.
know.
Yeah. All right. Well, let's submit this thing and see how we did. We probably got one wrong, but you never know. All right. We got them all. I just say that I'm so skeptical because I've been shocked so many times. All right. Let's see. Do you want, well, we're at an hour. Do you have any questions or I can go in, Carmen, and change the permissions on the week 2 on the homework. I'll do that so you can get in there. Any other questions? Robert, are you comfortable that you got caught up?
That was my question. I'm not sure. Question, discussions? Is there no discussion thread in this class?
You know, that's a good question because there is a, there are points given for attendance, but you have an excused absence, so I'll credit you that. And the fact that you're here today, I think, makes up for that. So I'll credit you for the discussion. We don't have discussion questions in a live class. That would only be if it were online. So there's 2 parts to that
Well,
answer. I didn't.
All of my classes that I took on campus,
Yeah.
we had a discussion thread that we had to
Not this time, though. Not this time. Not in
Okay.
this class. But
Okay.
but attendance is worth 20 points. So if you attend the remote session in the future, that'll be worth 20 points. Today, I'll give you credit retroactively for attending this homework session and the fact that you had an excused absence.
Okay, and then everything is due on Saturday evening?
I extended this week's homework till, I think, what is it? Carmen, was it Tuesday or something?
Yeah, it's, I think it was after the homework was, like after next class.
Yeah. So I added an extra couple days for everybody. I'll go and I'm not afraid to do that.
No,
if I think people had trouble with a certain week.
I just wasn't, because the syllabuses always say that it's on, everything's Wednesday.
Yeah,
whatever.
just go by what it says in Pearson because I set this and I'm willing to give people more time. If you have circumstances, let me know and I can set your permissions individually to give you a little more time.
Okay, and then that was the other question. Is there a code for the Pearsons, or are we purchasing that?
You would either rent you have to purchase the MyLab in order to complete the work.
Right, okay.
If you want to rent the book, you can pay the extra 70 or 50 or whatever it is dollars. Or you can make arrangements to buy the book. Some people find them online and things for less than it costs. Or they want to keep the book as a reference for the future. So
It's
how you want to handle it. But
not a big deal either way. I
Okay.
just wasn't sure.
okay.
So I think I just used there was a free 14-day thing. So that's what I did, so I could get started. Because
Yeah, good for you.
I
Okay.
don't want to be behind, you never get caught up in these things if you start out behind.
All right. Any
So,
other questions for me? I'm happy to take a minute if you have another question.
No, I'm good.
Well,
Okay.
not as far as the classwork, but I was just curious if you were gonna let us do like some extra credit assignments or other assignments.
That's a good question. I don't know what the school policy is on extra credit. However, it's such a fascinating time. I really think this is a time for us to have a discussion about some of the things that are happening in the world, because most people today, they go around about their business and they might notice that interest rates are kind of low, but there's some stuff happening today that's just unprecedented, and it's going to be looked back upon as an unusual development in the financial history or the scope of finance. It's just we live in a very unusual time, and I'd like to have some discussions about that. So let me first find out if I'm allowed to award those But I'd even consider having some kind of session, just an hour like this on Zoom, where we could get together and talk about some of the stuff. Because to me, this is the real teaching stuff, where someone who's been exposed to this stuff for years on end, and I can share with you just how remarkable it really is, and add some value to this class. Because the textbook and the things that are made, they don't really convey the nature of distortion that we have today in the financial system. It's really remarkable. So good question. Carmen, are you good for now?
Yeah, I was wondering, so like I said, the first chapter test was a little bit different than the homework. And then I was worried that so that's why I waited till after this to take the second chapter test. Like we didn't do any problems in the homework on the AA bonds or whatever. There was a big section of that in the book, but nothing on the homework. So I was wondering if it was going to be in the test, that kind of thing.
I don't know. Did we already, we did a quiz, right? So
we did chapter 1 quiz.
So we only did a quiz. I'm sure the tests are harder.
Well, I mean, it would be the chapter 2 quiz that I'm talking about.
Oh, okay. I see what you're saying. I can do a couple of these. I've got to leave in about 5 or 10 minutes, though.
That's okay.
But let's take a look at this. This is chapter 2. Money market instruments. This is good stuff. When you go to the bank and you do a money market fund, those are very short-term investments. And you'd have to know that Treasury bills are Treasury securities. Number one, they're less than a year as a rule, or 9 months, some people say. But there are also discount securities. Does anyone know what I mean by that? They don't trade at, they mature at par. And by the way, in the bond world, par is often $1,000, because that's what you would pay for a brand new bond normally. And that's what you'd get when the bond matured. But a Treasury bill is issued at a discount, and it doesn't make an interest payment. It merely accrues or appreciates to par or 1,000. So you might buy it at $980 and get 1,000 when it matures. And that's how you get the equivalent, the effect of your interest. Does that make sense?
Yes.
Yes.
So a T-bill is a very short-term instrument. A T-bond is 10 years and over, and money markets are only concerned with very short-term instruments. So it wouldn't be a T-bond. Preferred stock is the same thing. It's almost the longest kind of bond or fixed income investment that there is, because some of them are issued in perpetuity. What do I mean by that?
Forever.
Yeah. In perpetuity, perpetually. That just pays, until it doesn't. Common stock would not be in a money market fund because it's too much risk and volatility. Money market funds only have short-term, safe short-term instruments in them, okay? So T-bills would only be the ones included there.
Okay.
A primary market transaction. What did I say about primary versus secondary? Do you remember?
Primary is the first time it's sold.
Mm-hmm. Right.
Yeah.
So it would only be the new issue. Right?
Yep.
Okay. Default risk premium. Here again, we're backing into the different component of an interest rate, of a nominal rate. 10-year bonds yield 4.2. That's what? What rate is that?
The nominal rate.
That's the nominal rate. Good.
Mm-hmm.
Now, a corporate bond is 6.2. Why is it higher? They're both
Because
10 years.
It's less secure.
They're what?
It's the treasury bond is more secure, so it's less risk.
Okay, so what do we call that risk? Most of it.
Default risk.
Yeah, or credit risk, yeah. And so now they're saying that the corporate bond has a little bit of liquidity risk too. So now we just have to look at the difference. Well, the difference between the two is 2 points, right? The difference between the treasury and the corporate.
Yes.
And so it's 2%, but now they're telling us the corporate also has 0.3% liquidity risk premium. So that leaves 1.7. So it should be 1.7. I don't think it's going to get any more complicated than that. And maybe I'm missing something, but that's the difference is 2, and they're telling us that it has some liquidity risk. So we put that in there. What's left has to be credit risk.
All right.
I'd be surprised if it wasn't. Okay, money markets, all the following except which of these would not be a short-term safe thing?
B,
Read those, Carmen.
Yep, I'm getting there.
Okay.
All the following securities are sold in money markets except. Huh.
Common stock would not be in there. Never. Commercial paper is very short-term loans by big companies. 6 months, 9-month loans, and they trade them back and forth once they're issued. Because they're so short-term, they're considered very safe. Lehman Brothers created an exception to that. That's a good story in and of itself. Okay, Google sold its first common stock. What does that sound like? Money market, primary market, venture capital, or secondary market?
Primary.
Yeah, it's primary market. It's an IPO. All right, Kraft bondholders say Buffett wrong on Cadbury. Wow, I can't believe they're giving us this stuff in chapter 2 already.
Yeah, and I didn't get to read. Well, I don't remember seeing that in chapter 2. This was my concern.
Yeah, that is interesting, and it might be in there, and it might be tucked in there under the capital budgeting definition, but or it could be in one of those little inserts or insets that talk about things going on in the real world. But remember I talked about the discount rate to discount the cash flows to get to the price of a firm? Does everybody remember that?
Yes.
Yeah.
All right, well, we call those different things, and there are different techniques that you can use to analyze a set of cash flows to value a project or a firm. And among them are NPV, which is net present value. If a project at a certain rate adds value to the firm, then you can choose it or accept it. And internal rate of return is another one. Earnings per share is not very common. And even though it's kind of archaic, payback period is a more archaic, it's an older, oversimplified method where you measure the number of years to get your money back on a given investment. So earnings per share are not used, but the payback period is, even though it's pretty crude. Okay? The rest of those we'll learn about in time. Internal rate of return and net present value are pretty common ways of evaluating whether a project is worth pursuing or not. We'll learn more about them. But right now, I think they just wanted you to be aware that that's what they're called and that's what they're used for. A bond selling above par value is selling at
Premium.
Yeah, it's selling at a premium. Remember, I said par value is 1,000 almost always. For our purposes, it will be. And when a bond is more than 1,000, it means interest rates probably fell a little since it was issued, or they got a credit upgrade, a rating upgrade. But yeah, it's trading at a premium, and if it were below 1,000, it would be trading at a discount. So that language should be, it's common sense. It shouldn't be that hard to remember. A project that has a net present value implies that the value of the cost of the project is less than the value of the project, because after you run all your cash flow, discounted cash flow calculations, you come up with a number higher than the cost of the project. And if it's $50,000 higher and you take on the project, the theory is that you're adding $50,000 of value to the firm. And it's what it sounds like, net present value. So it's the first one that you come across usually in a finance class. So it would result in an increase in the stock, right?
Yes.
Should result. Which of the following is not a major function of an investment banker? Now, a banker lends money, and most often it takes deposits and lends them out for loans for houses and things like that. An investment banker is an underwriter. They help companies raise capital, and usually it's not exclusively, but it's bonds and stocks and sometimes preferred stocks. And they also help with mergers and acquisitions. So sometimes they're advisors, sometimes they're underwriters, and the word underwriting should take on special significance in this class. What industry do you usually hear most about underwriting?
Insurance.
Yeah, and underwriting means evaluating the risk and assessing a premium for that. Well, investment bankers do that. They look at a company and they assess the risk, and then they put a valuation on it based on the risk. So it's the same concept. Distributing, yeah, they help to sell the shares of that new issue. They help distribute it, and they often form a syndicate of other firms to help them so they don't have to take all that risk themselves. So regulating is left up to government agencies and other institutions. Sometimes some industries have some self-regulating entities, but here you're not going to let the bankers themselves, they're not going to regulate themselves in this example, certainly.
But they have to abide by all the current regulations.
Well, I mean, they're supposed to. I don't know how many of them do anymore, because all they do is get slapped on the wrist. You know, they pay a $50 million fine to make $5 billion in, wrongdoing. It's pretty corrupt, but unfortunately, banking's probably the single most powerful industry in the world right now. The blank premium is an additional premium return required by investors in long-term securities to compensate for the greater risk of price fluctuations over time. In other words, changes in interest rates. What are we talking about? The risk that interest rates could change the longer you hold on to a bond. Is it maturity risk or liquidity risk?
Maturity.
Mm-hmm.
Yeah? Yeah, it's maturity, clearly. And the liquidity risk has to do with the ability of converting securities into cash at a reasonably predictable price. Okay. All right, I've got to go after this one. Oh, no. Not this one. This one is so, it's everything we've already done. We just add up. And this one, it's actually so simple. that all you're doing is taking the corporate bond rate, which already has all those other rates in it, and you're adding the liquidity premium. Because the long bond rate has the maturity risk premium in it. It's got the real risk-free rate in it, the inflation premium, and the default risk premium. And the only thing you have to add is any, if any, liquidity premium. So 3 basis points. So it's going to be 3 basis points more than whatever the corporate bond rate is. There it is, right here. See
So
it?
it's 9.85.
So it's going to be 6 point. What's it going to be if it's well, you've got
3
to fill them all in, but it's you know, the real rate is the Treasury bill. Oh no, it's the Treasury bill minus the inflation rate. So that's going to be 31 or 34.34, or yeah, 0.34, and then inflation premium is 2.37, and then default risk is, oh geez, yeah, the default risk is the difference between the treasuries and the corporate. So that's 1.41 or 1.41, yeah. The maturity risk premium is the difference between the 3-month treasury and the 30-year treasury. So that's going to be 30 cents short of 3%, so 2.7. And then we have our little liquidity risk premium of 0.03. And it's going to come out to 6.88 because, as I said, all you had to do was just add the liquidity risk premium in. So that should be it. I'm going to submit. Oh, I can't submit it. But that's probably right.
Okay.
I mean, I can submit it and see how we did. You have not completed. Warning, warning.
Yeah.
You have not completed. Warning, incomplete. All right, so how did I do? What have I done?
Well, you only did 9 out of 15.
Yeah, I know, but I want to see. We got everything right that we did, except I got dinged on number 9 somewhere. Okay, everybody, thank you. Have a good rest of your weekend. Call me
Thank you
with
for your help.
questions. Call me with questions. It was nice that somebody showed up to hear me talk about finance.
Is this
What's that?
is this tentatively going to be every week?
You know what? I think I'm going to have to because it's as needed. If people show up, I'll do it. But I think generally this material is too hard to convey in just 3 hours of going over, PowerPoints and stuff. So I think probably I will.
Okay.
Oh,
Okay.
and I looked again, and I do not see any PowerPoints in this book.
I don't either, and I'm going to try to figure out what to do about it. I think they're out there. I'll just have to call someone at Pearson.
Sounds good.
Okay,
Okay.
thanks, everybody.
Have a
Thank
good
you.
weekend,
If I have any questions, I'll email you or text you, whatever.
And by the way, I hope this was recorded. Let me go back. Promise me I recorded
It
this.
still says recording up there.
Okay. Yeah, I recorded it, so I'll send the link out, and if you have a part of it you want to advance to watch again, that'll be available. Okay?
Sounds
Very
good.
nice.
Peace.
Okay. Thank you. Have a good rest of the weekend.
Okay. Bye.
Bye.
Hey, Bill,
Yeah.
when we try to find this recording, how do we find that?
How do you find
Is
what?
it on Zoom? Do we look for Zoom, or where do we look to find these recordings?
Oh, I'll send you a link with the recording.
Oh, okay.
What will happen is I'll put it up on my Google, my Google page, and I'll just send you the link to it there. I haven't figured out how to store them at Ottawa yet, but I have a Google page, and I just put the link up there, and then you can watch them on that.
Very good, thank you.
All right, thanks.
Okay, bye, everybody.
Bye.